Most people panic when the stock market crashes. They watch their portfolio collapse and assume the money is gone forever. But the top 1% of investors know something most regular investors never learn: a legal IRS strategy that can turn losing investments into tax-saving weapons. While average investors emotionally hold on to crashing stocks, smart investors are quietly recovering thousands of dollars from the government itself. And if you've ever lost money in stocks, crypto, ETFs, or tech investments, there's a very high chance you're leaving money on the table right now. Today, we're breaking down the hidden tax strategy wealthy investors use to reclaim losses and reduce taxes legally. Most investors think investing is only about making money, but wealthy investors understand something deeper. Losses can also create value. Here's what average investors do. A stock drops 50%. Fear kicks in. They either panic sell emotionally or hold forever hoping it comes back. But professional investors think differently. They ask, how can this loss work for me? Because under US tax law, investment losses can offset taxable gains and sometimes even reduce ordinary income. This strategy is called tax loss harvesting, and it's one of Wall Street's favorite hidden tools. Let's make this simple. Imagine you made $15,000 profit on one stock, but lost $10,000 on another investment. Most people focus emotionally on the loss, but the IRS sees something different. Your taxable gain is now only $5,000. That means you may pay taxes on far less money. Now here's where it gets interesting. If your losses exceed your gains, you can deduct up to $3,000 per year against regular income. And leftover losses can carry forward into future years. That means losing investments today could reduce your taxes for years. Wealthy investors don't just manage profits, they strategically manage losses too. So why doesn't everyone do it? Because emotions destroy strategy. People get attached to stocks. They refuse to sell losing positions because selling feels like failure. But smart investors understand something critical: a loss on paper is useless. A realized loss can become a financial tool, and many investors simply don't understand the tax system. They focus only on buying assets, not optimizing taxes, but the wealthy obsess over taxes. Because keeping money matters just as much as making money. Now there's an important catch. It's called the wash sale rule. If you sell a stock for a loss and buy the same or substantially identical investment within 30 days, the IRS disallows the deduction. This rule exists to stop people from gaming the system. And this is where strategy matters. Professional investors carefully rotate positions, shift sectors, or temporarily move into different assets, while still maintaining market exposure. The goal isn't just selling, it's harvesting losses intelligently. The average investor reacts emotionally. The wealthy think structurally. They understand. The market has cycles. Losses are inevitable, but taxes can be optimized. That's why many elite investors see downturns as opportunities, not just to buy assets cheaper, but to restructure portfolios for maximum long-term efficiency. And during bear markets, this strategy can save massive amounts of money, especially for high-income earners and active traders. So the next time the market crashes, remember this: the rich don't just focus on making gains. They know how to turn losses into leverage. And while most investors stare at red numbers in panic, smart investors are quietly using the tax code to recover capital and build long-term wealth. Because sometimes, the biggest investing advantage isn't predicting the market, it's understanding the rules everyone else ignores. If you want more videos exposing hidden financial strategies, market psychology, investing systems, and wealth-building secrets, subscribe now and comment below. Did you already know about tax loss harvesting? Or is this the first time hearing about it?